he's looking at the next term, right, as the next 4 years, and what he wants the Fed to do. And he wants his own people in there. I mean, that's a very smart move on his part, and we'll see. But with regards to a gold standard, an actual gold standard, it's next to impossible to create in this environment. But there are many ways of creating some sort of a gold constraint on the currency without actually doing a gold standard. So that might be in the works, and that will not surprise me at all. Well, you see the amount of central bank buying of gold. It's the biggest since 1965, and I remind you, in 1968 was the year that all governments, especially France, was adamant they want an audit of the U.S. gold reserves. So this is the same sort of a environment.
Hi, and welcome to the X22 Report Spotlight. Today we have a returning guest, Lior Gantz. Lior runs numerous successful businesses. He's traveled to over 30 countries in the past decade. He's an entrepreneur and investor. He's the founder of wealthresearchgroup.com, and I am very happy to have him back on the X22 Report Spotlight. Lior, welcome back to the Spotlight.
Well, thanks for having me, man.
Hey, thanks for being here. You know what? Let's start off with the Fed, because last time we were on, we were saying, the Fed's going to maybe raise the rates once or twice this year. Now the Fed has pulled back completely. They're not raising rates in 2019 at all. They might not even raise them in 2020. I mean, at this point, what is the Fed doing? Because if you look at the statistical numbers for the economy, I mean, they look incredible. Why would they be pulling back now?
So if you remember the last time I was here, I was talking about the Fed they're tied in a box and not being able to raise rates or cut them if they need to, but they're captive to the election cycle. And I told you that they will not do any dramatic move because they don't want to be the ones that are put in the limelight in case they destroy the momentum that Trump has now, his soaring approval ratings. He's at 45% again. So with that said, that is exactly what they're doing. They're pausing and they're waiting. They're waiting for it to either become so safe to raise or so safe to cut that on their end they wouldn't be blamed for anything. But the bigger story is even more amazing, because if you go to wealthresearchgroup.com/enemy, we've wrote an extensive report about how Trump is putting the Fed in a situation where only he gets to win and they only get to lose. He's using Twitter and he's using his political leverage, the fact that he is a political animal, and the Fed is trying to not be a political animal and not go and respond to him and be very, very corporate and corporate minded and not political minded. So what he's doing is he's telling them, hey, I want QE4 immediately. I want you to slash rates immediately. And I don't know if the Dow could have been 10,000 points higher. Why aren't you doing it? So he's putting all of this pressure on them to respond. Now, if they cut rates and it works, he's going to get all the credit for coming up with the idea, and the stock market soars. If it fails, if it backfires, then they're going to get blamed for succumbing to political events and not being thoughtful and mindful and economic, etc., not following the data, but following his pressure. And he's going to say they were too late. So it's all on them, and it's a brilliant move from the part of Trump for his own purposes. And that's why I think they're just looking for all the confirmation they can get before they do anything, before they either go and do QE4 and slash rates, which seems unreasonable, or if they raise rates. Now, the reason they will want to raise rates is because you have, they put aside unemployment figures, like unemployment, the 3.8 or 3.9, whatever it is. the official unemployment. It doesn't matter the number. What matters is the absolute number of people employed is 155 million, 120 million on full-time jobs, 30 million on part-time, about 7 million openings, and 7 million unemployed. So ideally, if all of the unemployed people were trained for the jobs that employers have open, you would have zero official unemployment. That doesn't mean that the United States, all of the people that can work are working, but all of the people in the job pool, in the labor pool, are employed. So it's a very tight labor market. But because these 7 million openings can't be filled with the skilled labor that is available, employees are having to to hire people for extra hours and to raise the wages on people. So you have a very tight labor market when it comes to labor cost, and that is right now the number one thing creating what we call a productivity gap, which is the difference between how profitable and how much growth the GDP can have and how much it does have. So there's a gap there. The gap is because of the tightness of the labor market. If it becomes even tighter for companies to have the same profitability that they have, they need to start laying off people or cutting and trimming in other ways. So however you look at it, we're hitting peak productivity for this cycle. The only way in this cycle that you can get more productivity is if you had a new cheap labor pool that you can tap into, and you don't. And therefore, we're really at the end of this cycle. Now, as opposed to a bear market, Dave, which is defined as a minus 20% in top to bottom for the S&P 500, a recession is not defined as a static event. It's defined as a trajectory. So historically, a 0.3 increase in unemployment, so going from 3.8 to 4.1, though it's still amazing in terms of the number of absolute people employed, that is a recession historically because it snowballs. More people are on unemployment. The government has to pay more people unemployment benefits. Other companies need to fire in order to stay competitive with the companies that have already fired and have their overhead trimmed, etc. It's a trajectory. It's a snowball effect. So unemployment at 10%, that's the end result of a recession. But a recession starts when you have a wave of initial unemployment and a wave of peak productivity, which becomes a situation. So recession is much nearer than people think. The fact that the economy is so red hot doesn't mean that recession is far. It actually means that recession is close, if that makes sense. So that's an important thing to understand. Now, what does QE4 or slashing interest rate, what will all of that do? What did QE1 do? QE1 came in December of 2008 when the economy was very slow, when unemployment was very high, when corporations were terrified of making investments, where investors were very terrified, and it jolted the top 30 million Americans, or the top 10%, the elite, the wealthy, the upper class, to trust the economy again, make acquisitions, make investments, do all of that, revive the economy. QE2 was the confirmation that the Fed was afraid of deflation and that they want more stimulus. Now, with all of these QE programs and slashing interest rates, all you're doing is allowing the rich to control the economy more and make more decisions. That's what you're doing with QE 1, 2, and 3. You're giving the cheap access to credit to the top people, the entrepreneurs, the capitalists, and they do with it what they want. And you hope that what they will do is will create a wealth effect and a trickle effect, but it didn't. In real life, only after Trump got elected, made tax cuts and deregulated, did small business and wages resume their optimism. And so now you're at a point where there's peak optimism. He has peak approval ratings for him. And if they go with QE4, with the stock market so expensive and with interest rates so low anyways, all you're doing is allowing the rich to, again, have free gains. But as of opposite or in contrast to before, I don't think they will go into blue chip. I don't think they will go into tech stocks. I don't think they will go to bonds again. I think they will move to inflationary assets, which they've ignored for so many years and have only invested in investments that do well in deflation. So I think that rotation, if QE4 happens, it will not have the effect that Trump wants, which is to have the Dow rally to the sky, the S&P 500 rally to the sky, to have corporations invest in capital expenditures and let Main Street enjoy this effect. I think what will happen is they will either start to put their money where it's cheap, which is Europe, emerging markets, and commodities, or they will get disgusted with this and ignore it and just stay cashed up and wait for the recession. So I think a QE4 environment and a slashing of interest rates will have it's a risky bet, a very risky bet. On the flip side, the Fed will love to have an additional 1 or 2 rate hikes if they can, without creating a huge blowback, because that will allow them the ammunition later on to cut interest rates when we head into a recession. No matter what, a recession is definitely coming. How severe will it get? It depends on how you manage it, because the institutions, the sovereign wealth funds, all of these big money pools, they're pretty much cashed up. They're not levered up like in 2008, and the problems that caused that recession and that slowdown are different this time. The problem this time is that the levered institutions, the ones that have real balance sheet problems, are the actual governments. And they're not too big to fail. They're too big to bail. And that is the real problem. Will the next recession bring these problems to the surface or not? Will we have a situation where nations falter, where bonds of nations get a haircut, where bondholders are told, hey, you're not going to get your money back, your principal, not your coupons, your principals, or we will have to print like crazy in order to pay you? And I'm not talking about the U.S. I'm talking about France, Germany, Japan, Spain, Greece, these countries that pay zero interest rates anyways. And that's why the U.S. is still able to lend money at 2.5%, because, hey, 2.5 to America or 0 to Spain, what will trillions? Where would trillions of dollars go, right? So I think this is the question of our times, and this is what the Fed is really antagonized over, and this is why the dollar is in a huge pickle. Anyways, because QE4 will unleash an inflationary environment. Recession will unleash a devaluation environment. And if both of these things happen together, well, that's even worse. So, and it's not just a problem that the alternative media is talking about. This is what the billionaires are concerned with. How will an economy that relies on 40% foreign investors to fund it, the U.S. I mean, that 4 out of every $10 that go into our deficit, that go into gasoline for our tanks, that go into paying Social Security for our retirees, Medicare for our retirees, interest payments on the existing debt, and income security for the people that are. How will all of this that gets funded 40% by other people, by other nations, how will they be able to afford this if they got problems of their own going forward to a large extent, and they're de-dollarizing? So I think that is a key point. And we wrote about this at wealthresearchgroup.com/Fed and /dead. And I think those are 2 critical reports to understand, because preparing, even mentally, even if you don't have a portfolio yourself, or if your portfolio is small and you're not afraid of what will happen to your portfolio, you're more afraid of what will happen to your livelihood and your income, etc. These are things that you have to know, because you have to beef up your savings as soon as possible, and prepare for an environment where you might be unemployed for 6 to 12 months here.
So, Lior, let me ask you this. My first question is, you said that the recession is closer than we all think. What time frame are you saying that the recession is coming?
So again, we don't think about it in terms of when it's coming. Think about it more in terms of when the economy becomes so overheated that companies cannot keep posting growth in earnings per share, even though they're buying back, billions and billions of shares, even though they're shrinking the amount of shares in their pool to make sure that it looks like they're growing, but they still are not able to post great earnings. The next thing they can do, which is easy for every CEO, is to cut a few thousand jobs. So the only thing you need to monitor is that. And obviously, I can't tell when the CEO of a domestic company is going to start laying off people. But I can tell you, we're inching very close to that, because that's the number one surveyed fear for CEOs in America right now. Surveyed right now. They asked CEOs what's their biggest concern. They said raw material cost and labor cost. Now you tell me, as a CEO, what can you do? Can you buy less raw material? Well, no, because you need to create products. Can you cut the labor pool? Yes. And so that is the burning fear for CEOs. And obviously, no CEO likes to send people home, or most CEOs don't like to send people home. Most companies are like families, but it will happen. And once it happens, that's the big sign that the economy is turning around. So, you can either continue to hold on to your positions and say, okay, I'm going to wait until I see, the real turning point, and then I'll start liquidating. Or you can liquidate in advance and waive a little bit of the upside that might still be left for stocks. Or you can just not buy anymore and have a long-term hold, because obviously long-term, the U.S. economy is still in great shape in terms of their corporations, and we have some incredible companies in the S&P 500 index. And historically, if you have a time, if time is working on your advantage, if you're 40 and you need that money when you're 65, I see no reason to do anything. You'll just have to be able to bite your lip when this thing goes down 25-30% and comes back a few years later, like it does, because the growth is in there. The U.S. economy will continue growing, government trouble or not. The corporations in America, or at least the best corporations, don't just rely on the U.S. economy. They're very much diversified within the entire world. So it just depends on your time horizon, how much you need that money. Is it consumption money for you or just investment money? And all of that plays into it. But definitely, this is a time to understand that the risk-reward ratio inside of the stock market is definitely not that high for blue chip and tech and the stuff that has worked beautifully for 10 years.
No, the reason why I was asking is because is Trump you're saying that, Trump is kind of like pushing the Fed around, having them do what he wants them to do. He wants them to cut rates. He wants them to start up QE4. Is he doing this because we have the elections, something like a year away? Does he want the economy to last, past the election point so people will see that the economy's still strong and he's reelected? I mean, is he doing all this just to get us through the election process, and then after that, he can do whatever he wants?
Yes, exactly. Exactly right. So what he wants is a strong economy going into the election cycle, getting elected, and then he knows that there's going to be a slowdown. Look, the engine for the U.S. economy going forward in the next decade is the millennials entering the workforce and getting more and more skilled as boomers continue to retire. So the wages for millennials go up, and those people, compared to the demographics of baby boomers, those people don't have homes, cars, they haven't taken vacations, they haven't made any big expenditures. So for them, they're the real growth engine for the U.S. economy. But banks don't lend to them because they have a giant $1.5 trillion obligation to student loans, and they don't like the auto industry anyways. A lot of millennials either commute in other ways, or they're very urban and they don't use that. Or they use mopeds or all that kind of stuff that is more mobile because they don't have families yet, etc. They're late to marry and late to have children, and so the real organic growth is not there yet for the U.S. economy, and you're just going to see a lot of pressure coming in from more exiting baby boomers, while the millennials are not creating a huge construction boom, which is what has created more wealth in America than any other industry. In the past 250 years, 76% of American millionaires have come from real estate, including the president. So with that in mind, we have to understand that the U.S. has real organic problems. And therefore, what Trump will probably have to do as a second election, as a second term, is make some very tough decisions. He will have to either tackle some of these entitlements and make it more difficult, I would say, or harder to get your entitlements. You want your Social Security? Well, you have to work part-time. You have to show us a pay stub that you work 20 hours this week or something like that. Well, he'll perhaps postpone the retirement age for Medicare and Medicaid. There's all kinds of things that he will need to do, especially if international forces put a lot of pressure on the dollar and he can't issue bonds at these very convenient rates. So going forward, a lot of issues, a lot of trouble. And as China continues to become a more influential economy and a more influential political entity in the global, in the global community, and they pose more of a threat to the U.S. in terms of how many allies can they migrate over to their side of the road. This becomes an even bigger problem. So I don't think that we're looking at any cuts to entitlements, but I think that we're looking at some revisions to entitlements. And I think what will end up happening is that either the free market, entrepreneurs, CEOs, corporations will find ways to revive some of the problems and get out of the problems that America has, and I'll list them right now, or the government will need to enforce them as a matter of regulations and laws. Let me tell you what I mean by that. For example, you have a pool of 40, 45, 50-year-olds that are displaced. They worked at one profession for a decade or more, and now their corporation has sacked them because they've either automized, outsourced, or done something that they don't need them anymore. They two people have done the work that now one person does. And so what the government will probably do is either mandate that corporations give people a larger severance pay so that they can be a longer, have a bigger time out and not get stressed out, or they'll force these corporations to retrain these people before so they can leave to the labor pool with a new training, with a new skill. And that might be government mandated. On the flip side, the corporations might do something where they try to recruit people to courses and training in advance. So this would happen where people that are 15, 16, the corporation will come into their schools. They will say, hey, after hours at 4 to 7, we're going to show you how to become an employee of Coca-Cola if you want to in the future. And this is a course that you're going to go through for 6 months. And then once you get a job with us, then you're not going to get paid for the first 3 months or whatever because we invested this money in you. So that's if the free market will do something with this. But whatever it is, the U.S. has a problem because they cannot compete in labor with the rest of the world. And this is not just the U.S. This is Europe. This is Japan. This is the Western world. So they need to only compete on quality. They need to only compete in terms of, hey, our finished goods, our tech goods, our intelligence, our computers, our planes, all the stuff that we can do with our talents, with our labor pool, with our brain power of Americans, you can't still, right? Because you're 40 or 50 years behind in terms of the quality of the people. But the problem is that millennials go and they have an art degree, or they have social studies degrees, and those degrees do not help them in the real world. They're not trained to create innovations. They're not trained to tech, and that's what they need to understand. And it will either become a national problem addressed by the government, or it will be done by the free market, because corporations will be distressed. They will not be able to find good employees, and they will need to figure this out on their own. But this is the real problem. How can America continue to find competitive advantages in the 21st century? The competitive advantage that brought the U.S. to stardom and to the middle-class economy and all of that was just the fact that after World War II, there was no other powerhouse intact. Everything else was demolished. Countries were out of infrastructure. They need to rebuild the city itself. And the U.S. was a powerhouse that didn't get hit. And they banked on that and capitalized on that for 30 or 40 years until the 70s or 80s, when the rest of the world recovered completely. But now it's gone. So people have to come to grips with that. You're competing now on a level playing field with the rest of the people in this world. And the only way to beat them is fair and square. So the magic wand that the U.S. has for now on, for the time being, is the fact that they can issue bonds at very low rates and do that for a long, long time here, right? They can issue trillions of debt. But if the debt has no return on investment, negative return or zero return on investment, like these social programs that create zero return on investment. It's not like an infrastructure where you create better ports and better airports and tourism picks up and shipping picks up and tax revenue goes up. Paying your elderly does not create any positive effect on the economy. It creates a healthcare bubble. That's all it does. So if the government starts to issue bonds where they have a better return on investment, that is the best solution that the government has right now. Obviously, in a utopian world, you abolish the Fed, you do, there's many things we can do. But I'm talking about real life, real world. That is the strength of the U.S. is that it can still issue bonds, and as long as Spain, Greece, and Germany and Japan offer you zero rates, people will still buy U.S. bonds. But if they continue to just dump them into defense and very bad educational system and all that stuff that doesn't work, then it's money down the drain, and that is very unfortunate. So, I hope I didn't go and answer this in a too complex of a manner. But the real issue is, what will the government do with the power it has to issue bonds? Can it do it more constructively, or is this going to be a disaster from the government standpoint? Because once they lose the ability to issue cheap bonds, it's over. It's done. Once the reserve currency is at risk and the confidence is done, then people who don't have savings and people who don't have a plan B and people who don't have real skills, all of these people that are relying on the government aid, that's going to be a very big problem, because half of them are not going to get what they were promised, or all of them will get half of what they were promised. In other words, the rubber will meet the road at that point. And the real question is, can and will CEOs, entrepreneurs, and the free market come to the aid of the United States economy and be the solution? Because it's a very tough challenge to, as an entrepreneur, without the proper support, create a situation where you help more people get into the economy and educate more people. That really is hardly the mandate of companies, right? To make sure that the citizenry is being taken care of. CEOs would rather outsource than spend a lot of money on local talent, right? Because that's what's good for their shareholders. So it's going to be very important to see how the country socially and morally handles the problems that are ahead of it. There's really no easy answer here.
I mean, do you think that's why Trump is pushing so hard to change NAFTA and to have companies come back to the United States? And he's telling like automobile manufacturers and other manufacturers and other companies come back to the United States because he realizes that we need to have manufacturing. We need to have these businesses here because the next phase is going to be completely different than the way it is today.
Think about it. The reason that he wants manufacturing to come back is because he knows that the dollar is going to be very, very weak going forward. So he knows that actually goods and services will be able to, and products will be able to be competitive on a dollar basis in like a decade or two. So he's already working off of the premise that the United States will not have reserve currency role going forward. That's why he wants all these manufacturing jobs back. But yeah, of course, he wants to make sure that the United States is prepared for the day that the world doesn't look at it in a different eye. That the world looks at it as an equal to other countries, and they will only buy our goods. He wants to make sure that when push comes to shove, and in 5 to 6 to 10 years, the United States does not have the reserve currency role, or that the dollar is not used for 60% of the world's transactions, but only 30% of the world's transactions, and it's devalued by almost 50%, that the United States now has a very competitive currency, and he wants manufacturing to be home-based. He doesn't see any reason for manufacturing to be outside if the currency is on a path to become much more much cheaper. Remember, as weak as the dollar is already, it's still artificially strong because there's so much forced demand in it. So it would have been 20 to 30% cheaper if it wasn't the reserve currency, maybe more. So that's what he wants. And obviously, as any president and as any businessman, he's looking 10 years ahead here and 15 years ahead. And that's what his think tanks are telling him. Presidents don't look at the day after. They look they look at charts from the UN on how population growth would impact 2050. And that's what he's doing. He's taking long-term steps to solve or to mitigate risks that will come in at 2030, 2035, etc. But the markets price them in way before that. So even if a problem will emerge in 2030, people are looking at the charts for it right now. And America is not growing in terms of demographics. People are not having 3 babies. And the labor pool is not getting bigger and bigger and bigger and bigger. It's happening in Europe as well. And it's happening in Japan and China and Russia. The only continent that is growing leaps and bounds in terms of their population is Africa. And therefore, in 10 years, the U.S. economy or the U.S. population will be about 3.5 to 4% of the world's population. So it's a very small country, all told, with a lot of advantages and the untapped potential in terms of the free market system, etc. But still, think about it, and you'll see what I mean. It's a small country in terms of what it will impact the world if the dollar is devalued for 50%. So he wants to beef up any domestic manufacturing and any talent that he can bring home.
So during this period of time, as the Fed is not raising rates and he wants the Fed to lower rates and start stimulus once again, what happens to gold and silver and cryptocurrencies? Are these going to move up? Are they going to stay where they are? The manipulation is still going to be in place?
So with gold, the underlying catalysts for gold to be higher in price are, one, the stock market has done tremendously well in the past 10 years, but gold is still up from 850 in 2008 to about 1,300 today. So in a bad U.S. stock market, that's going to be better. Remember, the dollar is trading at an all-time high at 72 currencies. So if you were to take an arbitrage, in other words, if you were earning salaries in the past 10 years in dollars, switching them to weaker currencies like a euro or a Canadian or a Swiss or Australian, etc., and then taking that money, converting it to gold, then you'd have a very good pile of gold, because it's trading at an all-time high in these many currencies. Then you can switch it into real estate, etc. So gold is a very international investment. It's not an investment that works well if you're an American per se. It's an investment that works well if you're thinking about it in terms of, hey, gold is a currency that competes with it's money that competes with other currencies. And if you think about it in that manner, it's done very well. But it can do far better if the dollar is going to get weaker. Remember, the dollar index has been on a 7 to 8 year bull market compared to other currencies. So the cycle for it to go into a bear market is here. Dollar bull markets continue usually 8 years. And the euro is very weak. China's putting a lot of stimulus in their currency and backing it with gold. There's no reason for the dollar to continue to be strong. In fact, 2018 was the peak where the dollar was the best performing asset in the world. That is peak dollar. And so you're heading into a dollar bear market. Gold has a very good future in terms of its relationship to the US dollar. It has a very good future in its relationship to stocks. It has a very good future in its relationship to recession fears. And therefore, I don't see a reason why it has a lot of downside. Now, I'm not saying it's going to go into a bubble or a mania or a panic, but it certainly has a lot higher to go in terms of how much of the currency it covers. It only covers 7% of the currency. That's an all-time low for gold in the 21st century. So if you go back to 1980, it covered all of the currency supply. For it to go back to that, you'd have to multiply the price by 14. And for it to go even to 20%, which is the low gold standard, it would have to triple. So there's a lot of upside for gold. For silver, if I wrote 2 very detailed report about the silver situation because it's nuts. If you go to wealthresearchgroup.com/rally and /ratio, they both talk about this 80-to-1 anomaly between gold and silver, but it can last. Silver can stay cheap for a very long time because it's hardly a monetary metal for governments anymore. It's practically only the free market, just retail people that buy silver as an investment. And therefore, unless there's an inflationary scare or real inflation, you won't see silver trading at 30 or 40. But if there is, you will see it do it very, very, very fast. With regards to cryptocurrencies, what I think they've proven is that, first of all, they can withstand a large bear market. 85% down, and it's still taking blows, and it's fine. The risk was that once it was down to that to that $3,000 range, that investors would say, okay, I don't like it anymore at all. I don't like it at any price. And then it will go back to just nerds loving it, or these crypto people that are really crazy about it, loving it, but it won't have a future. It will just be always on the fringes. And it did not happen. So Wall Street's coming in. More companies are looking at crypto, and it's in Venezuela and in Turkey. It's proven to be more practical than gold. If you want to turn your fiat into crypto and hold it on a key, on a ledger, a hard wallet, and leave the country, that's much easier than taking gold bar with you. Practically, it's you can put it in your pockets like diamonds. So in terms of distressed countries, it's proven itself to be effective, there's a lot of distressed countries out there. In terms of not distressed countries, so the Western world, as it becomes more scalable, so as it becomes able to do more transactions than it does right now, so as it is becoming able to do more transactions and compete with Visa and MasterCard and PayPal, etc., in the next 5 to 10 years, it's going to become more convenient, more user friendly, and then you'll see it in the mainstream. if it happens, right? If the developers are able to do it. And then it might have a huge premium on it in terms of if it becomes a scarcity issue where central banks want it and they want and institutions want it, and then it can really be a very valuable asset. Remember, don't think about its intrinsic value in terms of, hey, it's digital. Many things that are digital have incredible intrinsic value. The domain name Amazon.com is worth billions, and it's just a digital domain name. Don't think about it in that regard. Think about it in the terms of utility that it brings and value that it brings, because that is what's important with it. So as long as governments continue to mismanage their own currencies, there's going to be a room for Bitcoin out there, and perhaps other altcoins that are geared to be currencies, such as Litecoin, etc. With all these other altcoins, all they are is basically little startup companies that instead of getting listed on the stock markets, they're listed on coin markets, on coins exchanges. But literally, you own a piece of a startup company that trades 24/7 and may pan out to be the next Google, and may pan out to be like 95% of tech startups and go back to zero and delist and lose shareholders' value and becomes worthless or next to worthless. So you're taking a huge risk. Bitcoin is a different animal than the other altcoins because it's just altogether different. So when you talk about that, that is important to understand. For right now, all of them sort of trade in the same manner, right? If Bitcoin goes up, they all go out, they all go up, and if Bitcoin goes down, they all go down, like thousands of them. But this is going to change in the next 2, 3, 4 years as they separate their ways from each other, and those start to be viewed as just little companies, and that becomes viewed as a sort of a safe haven quasi currency that might have a big future as a real currency, as a real medium of exchange.
So I just wanted to touch upon this. The IMF and the World Bank, they're looking at this learning coin. I don't know if you heard about this, where they're going to simulate an economy using cryptocurrency. Are they preparing to do something? What do you think they're trying to do here?
Well, again, so a cryptocurrency, all it is another form of currency like a dollar, but it's not on the SWIFT. It's on a different database and it runs on different software, etc. The cryptocurrency itself is not the major innovation. The major innovation here is that Bitcoin does not have to do with any government, and it trades independently of any particular national event. Now they can tax it and they can do all kinds of stuff with it to make you not want to touch it, right? If cryptocurrency gains were taxed at 90%, then it would kill all of the speculators from coming in there. But the advantage of it is the fact that it's not connected to any government. IMF and any institution that is as international as that, talking about cryptos, it doesn't make me feel any good. It's just more talk about that one world currency vision that they had since the 60s. So hopefully that doesn't happen, especially when it's on their ledger. That's the worst tyranny, when you have one body or one institution holding captive everyone and you play with their credit, right, with their currency. So I do not like that idea at all. It doesn't sound good to me, not in terms of my sovereignty, my independence, or any other regard.
Let me ask you about the Fed once again, because Trump, and we talked about this in length, but Trump is nominating 2 individuals, Herman Cain and Stephen Moore, and Herman Cain is a really big gold bug, and they're outside of the system. Do you think Trump is bringing people in to restructure the Fed, or maybe introduce gold?
Well, if any country can consider introducing gold, according to the official numbers, it would be the U.S. It has more ounces than anybody else, far more. With regards to if I think that's what he's considering, I don't think so. It's too unrealistic. Like I said, it would mean gold prices would have to be much, much higher, and I don't think that they're ready to take that sort of a step in responsibility. Remember, he just cut taxes, which means he just made it a certainty that the deficits would be higher in the next 10 years. Every year it will be over $1 trillion. But he is trying to put people that have the same frame of mind as he does with regards to what he wants to be done. So I do think he's putting his own people in there, that's for sure. He's not. He's looking at the next term, right, as the next 4 years, and what he wants the Fed to do, and he wants his own people in there. I mean, that's a very smart move on his part, and we'll see. But with regards to a gold standard, an actual gold standard, it's next to impossible to create in this environment. But there are many ways of creating some sort of a gold constraint on the currency without actually doing a gold standard. So that might be in the works, and that will not surprise me at all. Well, you see the amount of central bank buying of gold. It's the biggest since 1965, and I remind you, in 1968 was the year that all governments, especially France, was adamant that they want an audit of the U.S. gold reserves. So this is the same sort of a environment. Governments do not trust each other right now. Literally, they do not trust each other. Everyone knows that the world politically is divided, and that there are problems, and that you can't trust any government to be on your side. So they're all beefing up their gold reserves because gold is real money. And they all know that. They know that currencies work when there's confidence, and gold works when there's no confidence. So that's why they're doing it. Russia is not even being secretive about it in terms of like they dumped 85% of their dollars, and they're just beefing up gold. China is doing the same thing. Italy, the deputy prime minister wants the gold from the central bank to go back to the government. So that's like that's saying we don't even trust our own people, let alone other people. So definitely this is a huge shift compared to where we were when there was open borders and globalism, and governments were trusting and willing to lend each other gold. With everything that's just happened with the Bank of England, etc., governments just do not trust each other with regards to their gold. They don't even want to store their gold with other banks.
Lior, thank you very much for being on the X22 Report Spotlight. Once again, how can people see your work?
The best way, honestly, the best way is to be a subscriber to the free newsletter, because that's where I publish our most in-depth, highest priority, and highest quality information on a very timely basis. Also, you can go to the website. If you look at the top menu, you'll see Special Reports tab. Click on that. It's a huge wealth of it's a library. A wealth library, basically. It's aggregated all the PDF reports that I've ever published. And actually, once you download any of them, doesn't matter which, the automated email that gets sent to you, at the bottom of it, if you scroll, there's all the other ones. So you don't have to keep saying, hey, I like this one, I'll download it, etc. You don't have to download a million of them. They all come in one batch. So we made it easy for people. And so that's, secondly, if you want the dedicated report that I created for this interview for your people, it's wealthresearchgroup.com/bear, and that's 11 bear market strategies, my proprietary strategies that I use in order to control everything during the bear market in my portfolio. And if you go to wealthresearchgroup.com/gold playbook, that's the most extensive gold investing manual online, bar none. So those are two things that I created for your viewers and listeners, and I hope that it brings them a lot of education.
Yeah, I'll put all those links at the bottom of the video to make it easier for people. They just click on them and you can go right to those reports and everything like that. Lior, once again, thank you very much for being on the X22 Report Spotlight. I really appreciate it. Thank you very much.
Thank you, sir.